Everyone knows about investment banking, but what if I told you as an investment banker myself that there are 7 other roles in finance that can get you to 6 figures, often with better hours and a better lifestyle? And the truth is, you're probably closer to one of these roles than you think. If you're in tech, engineering, or accounting, your skills may map directly into one of these roles. Now, some of these roles you will have heard of, others you won't have, but if you watch through to the end, I'll break down not only the most attainable paths, but also some of the sexiest roles in finance that people dream about. If you're new here, I'm Harris Amir, an investment banker and CFA charter holder, and I broke into the industry without a finance degree. And now I run Charter Mastery, where we help people transition into finance and build the careers that they dreamt about. And because of my seat in leverage finance within investment banking and my network across banks and funds, alongside my clients at Charter Mastery, I get to see the full spectrum of roles in finance. So let's break down the 7 that can land you that 6-figure paycheck. Now, if you want to work directly with the CEO and CFO of a company and understand how the whole business fits together, FP&A is where you live. FP&A stands for Financial Planning and Analysis, and that's the first role that we'll discuss. Generally, FP&A is high impact, visible, and the hours are much more reasonable than banking. Imagine the CEO calls an emergency meeting because revenue misplan. Well, who explains what happened and who suggests what to do next? That's FP&A. Now, the title may vary. You may see FP&A analyst, strategic finance, business finance, but the job is the same. Build driver-based forecasts, track the moving parts, and tell the story of the business in numbers. And that story directly drives decisions, whether the company hires or cuts, invests or pivots. And if you want to be in front of people that make decisions, this is one of the only jobs outside investment banking that puts you there. And look, I've sat in rooms with MDs and CEOs and worked on multi-billion-dollar deals, but as a banker, I tell the story of a company to outsiders, i.e. investors, markets, and potential acquirers. FP&A, on the other hand, tells the story inside the company to the people running it. And unlike investment banking, you actually get to see whether your analysis changed the outcome because you're in the room when the strategy shifts. Now, in terms of the day-to-day, you'll be building budgets and forecasts. You'll be doing variance analysis, i.e. why did actuals differ to the plan? You'll build management reporting and board packs for presentations. And you'll partner with the sales, ops, and marketing teams to challenge assumptions and make sure everything is running according to the strategy. In terms of hours and pay, hours-wise, you're looking at 45 to 55 hours per week, can be busier at month end and ahead of board meetings, but generally it's pretty sustainable. Now, pay starts around the $65,000 to $85,000 range for analysts and can step up into 6 figures for associates and managers, and eventually up as high as $150,000 to $200,000 for directors, plus bonus and sometimes equity. Now, of course, this is not hedge fund or private equity type pay, and we will discuss these roles in more detail shortly, so stick around. The important part is it's not just about the pay. You are building a skill set that is transferable to pretty much any company across any industry. Now, in terms of breaking in, it's moderately difficult. So unlike private equity or hedge funds, pretty much every big company has an FP&A team. So think every company on the S&P 500 or the FTSE 250. But the bar for the best teams is high, of course. They don't just want people who can crank Excel. They want people who can see businesses holistically. And for that, you need to be able to demonstrate judgment. You need to be able to say why the numbers have changed and what you should do about it. And having this business acumen is really important. I can't stress this enough. I say the same to my clients at Charter Mastery because some people just want to skip the junior analyst years and straight to a 6-figure role. But to do that, you genuinely have to stand out. And for that, you have to have business acumen. Now, whatever your background is, it can give you an edge, but it's all about how you frame your skill set. And if you can do this well, you might be closer to that 6-figure role than you think. For example, if you come from accounting, you'll understand processes and financial close cycles, so monthly, quarterly, annual close cycles. If you're coming from engineering or ops, you already know how to think in terms of systems and efficiency. If you're coming from consulting or analytics, you already have a structured problem-solving mindset. Then if you want to stand out versus generic resumes, you need to determine what the employer is actually looking for and then show some real examples of this. For example, show that you can build a driver tree explaining revenue growth or a variance bridge from plan to actuals, or otherwise a crisp board-style memo. So the takeaway here is that FP&A is the translator of the business. You're the one who makes sense of the numbers so the leaders can act. So you'll get executive exposure, you'll make a real impact, and the hours are very reasonable. So the first step here, rebuild a public company's last 8 quarters into a model and then explain one of the quarters' earning miss on one page. This way you'll instantly look like a finance partner rather than a general applicant. Now, every company has a heart, and it's the balance of cash flowing in and out, and corporate treasury is the team that keeps that heart beating. Now, you might not hear about them a lot, but without corporate treasury, the lights will literally go out. Now, if FP&A is about telling the story of performance inside the company, think of treasury as a financial control room that ensures the company never runs out of cash. And the job sounds simple, but it's actually complex in practice. Treasury has to manage cash and liquidity, i.e. the ability of the company to meet short-term needs, and otherwise manage risk. That means forecasting cash, deciding when to borrow or invest, managing debt and credit lines, managing interest and currency exposure, and otherwise maintaining relationships with banks. Now, the title might vary, could be treasury analyst, treasury associate, cash manager, but at the core, the job is the same. Keep the business safe, liquid, and manage risk. Now, in terms of the day-to-day, you'll be forecasting cash and stress testing liquidity. You'll be moving money across different accounts globally depending on where it's needed most. You'll be negotiating credit lines and monitoring debt. You'll be hedging currency and interest rate exposure. You'll maintain regular dialogue with the banks. Hours are usually around 45 to 55 hours per week, and this can spike around earnings season or if the company is refinancing, or otherwise when there's big market moves. Now, pay starts in the high 5 to low 6-figure range, and this can step up to $200,000 plus for senior treasurers at large companies. Now, of course, this depends on which country you're in and which company you're in, but there is solid earning potential here. And generally, when I'm referencing pay ranges, I'm typically referring to the US, Canada, Europe, GCC, the sorts of locations where it's a bit easier to earn 6-figure salaries. And that's typically where our higher earning clients at Charter Mastery reside. Now, in terms of entry difficulty, I would say it's moderate. Most sizable firms will have a treasury function, but the top firms will be pretty selective. They look for people who are detail-oriented, risk-aware, and otherwise familiar with systems. Now, in terms of common entry routes, accounting is a natural segue because you'll be familiar with close cycles, cash flow management, and generally have a control mindset. FP&A can also be a natural stepping stone, and we discussed that in part 1 of this video, but generally, people who want to step up and take more control of liquidity may look to move into corporate treasury. And if you've worked in operations, payments, or procurements, you can usually find an angle which might be that you're familiar with working capital flows. But generally, if you like puzzles and solving problems, such as what happens if cash is tight in week 7, or how do we hedge a 10% decline in the euro, then you'll probably like treasury. And just to remind you, I broke into investment banking without a background in finance. So it's definitely possible to land these roles. You just need the right strategy. What's really important is your technical skills, business acumen, positioning, networking, mindset, and as I said, having the right systems and strategy. So to summarize corporate treasury, it might not be the sexiest role in finance, but it is one of the most critical. You'll keep the company solvent, i.e. able to service its needs, and you'll influence billion-dollar financing decisions, and you'll do this with hours that let you breathe. So if you're interested in treasury, the first step is to pick a public company, build a 13-week cash forecast, and then overlay an FX sensitivity, stress testing what happens if the dollar strengthens by 5%. If you can do this, this is real treasury thinking. Okay, so we've talked about the internal finance seats, i.e. FP&A and treasury that keep the engine running. Now let's look at a more traditional Wall Street style type finance role, corporate banking. The kind where you know the client's kids' names and they call you first before they make a big move. That's essentially what a good corporate banker does. You're the first phone call for business owners who need capital to grow. So corporate and commercial banking, the interchangeable terminology, can sound a bit dry until you know what it actually involves. Imagine you're sitting with the founder of a mid-sized company and they want to expand into a new region, but they need capital to do this. You're the one who structures the loan, pulls in the treasury services, and essentially makes it happen. And with respect to this lending, you'll often hear the word credit, and this just means assessing whether a company can safely borrow money, on what terms, and how they're going to repay it. The title for this role will vary, but it's typically relationship manager or corporate banker, and essentially you will own a portfolio of clients and your job is to grow it and protect it. At bigger banks, corporate bankers will sit in coverage teams alongside product specialists such as FX or treasury, and they'll all work together to serve the client. This is similar to investment banking coverage, but with a sharper focus on lending and long-term relationships. So in terms of the day-to-day, you'll be managing a portfolio of clients, and this can range from mid-market clients all the way up to blue-chip large corporates. You'll be structuring loans and credit facilities and essentially deciding the loan size, pricing, term, and risk protections. You'll also try and cross-sell other bank products, so that can be, as mentioned, FX, treasury, trade finance, etc. But overall, the objective is to build deep client relationships, so you'll be going on lots of lunches, conferences, site visits, and generally you want to become the go-to banker. Now, in terms of hours, you're looking at 40 to 50 hours per week, and your schedule often closely aligns with client schedules, so if they're out, you're out. So as I said, you'll be at a lot of lunches, conferences, and generally out and about a lot, building relationships versus crunching spreadsheets. Now, pay here can be very attractive. Analysts may start around the $60,000 to $70,000 mark, but once you're an associate and increasingly as you move towards director and you assume more ownership for the portfolio, your pay will step into the six-figure range and eventually can rise to $200,000 to $300,000 plus as a director or a managing director who has a large portfolio of clients. In terms of breaking in, I'd say it's probably moderate difficulty, so banks will typically look for people who can handle clients, who can speak confidently, and people who understand credit risk. If you've got sales experience or have worked in client-facing roles in tech, consulting, or even in small businesses, this can be a big advantage. You definitely don't need to be a modeling expert for corporate banking. I'd say here personality matters more. If you can build trust, explain financing in simple terms, and otherwise connect with people. I've worked with lots of corporate bankers who didn't come from a traditional finance background. They came from other industries with transferable skills and otherwise broke in because clients simply liked them. And this speaks to the importance of being able to build relationships and trust. And this is something I emphasize to my clients at Charter Mastery. Because the truth is, the best roles never really get posted on job boards. They get placed directly through referrals or through relationships. So here, it does help to be part of a community of like-minded people, and that is what we're fostering at Charter Mastery. So the big takeaway here is that corporate banking is all about people. Yes, you need to understand credit risk and structuring to some extent, but otherwise your career will be built on trust. Now, if you like having conversations more than you do number crunching, and you want a finance role that pays well without hours that burn you out, this could be the one. So if you're interested in corporate banking, the first step would be to identify 20 businesses in your local area and then see what information you can find on them. For those with revenue available, try and guess their financing needs. Maybe just pick one or two and draft a crisp one-page memo to try and articulate this and start thinking in the way that a corporate banker would. Now let's look at a role that's everywhere in finance but is often overlooked, and it's critical to how firms manage risk and protect billions. Now imagine being the person who spots the iceberg before the ship hits it. That's risk management within finance. You're not the one placing the bets, but you're the one that ensures the firm survives to play again another day. Think of risk managers as the control tower of a bank or a fund. So while the traders and the bankers are chasing returns, risk are asking what could go wrong and how can we manage this? Now there's three pillars here. Market risk, which relates to movements in market prices, foreign exchange, interest rates, etc. Then you have credit risk, i.e. can the borrower actually pay? And then you have operational risk, i.e. systems, controls, cyber, and compliance risk. Now making this all sound very defensive and unsexy, but the reality is a high quality risk function will ensure a company or a firm takes much smarter risk and is able to actually withstand shocks. So clearly they are very important, and let's look at what they do day to day. Now the credit and market risk teams will often connect with front office roles, so they act as a check and balance and make sure they don't do anything silly. And if you work in credit risk, you'll actually be plugged into specific transactions. And if you face into the investment banking teams, you will be working on investment banking deals. Market risk teams will actually monitor exposures across trading books, and they'll run scenario analysis and stress test it to see that it can withstand shocks. And your operational risk teams will be monitoring operational processes such as cyber, compliance, etc. In terms of hours, you're looking at 40 to 55 hours, and generally it's pretty stable, but it does depend on which team you work in, and in particular parts of the year where there may be regulatory focus or stress test deadlines, it may be more intense. And otherwise, if you work parallel to an investment banking team, as I said, you do work on those deals, so it can be more intense and longer hours. In terms of pay, early roles can start in the $80,000 to $110,000 range, and this steps up gradually over time. And senior risk officers at large banks can sometimes earn $200,000 plus with other incentives. In terms of breaking in, the difficulty is moderate. Risk is always in demand. The regulators require it, and the banks can't run without these teams. Generally, they look for people with a control and slightly cynical mindset, so people who spot flaws and otherwise challenge assumptions. If that sounds like you, risk management could be a good role for you. As an aside, the CFA can be a great stepping stone if you don't currently work in finance and you want to access risk management. Now, in terms of common entry routes, if you have an engineering, quant, or mathematical background, you'd probably be a good fit for market risk. If you've done audit or accounting, that's a natural path into credit risk. And if you've worked with IT, cyber, or systems, that's a natural path into operational operational risk. So to summarize, risk management is a role that actually lets you sleep at night. You get the credibility of working in high finance and the impact of protecting billions, but you don't need to burn 80 hours a week to get there. So if you're interested, the first step may be to pick a recent market shock such as the tariff volatility or interest rate spikes or crypto swings, and then pick a particular industry or company and summarize the impact of that shock on that company. Then try and overlay how that risk could have been managed, what controls and improvements could be implemented. Now, let's discuss a role that you probably don't know about but gives you real deal exposure and earns you serious money. You've probably heard of private equity, which involves buying companies, and we'll talk more about this in a second, but what if you could make Wall Street style money without actually buying companies? That's private credit. Instead of buying equity, you're directly lending to companies, typically mid-market companies that can't or don't want to access financing from traditional banks. It's deal-driven, prestigious, and it's one of the fastest growing parts of finance right now. It's literally exploding. And my private clients at Chartered Mastery have already set their eyes on it because it's only really an opportunity that people with inside information know exists. So private credit funds provide debt financing to companies, and this can be senior debt, mezzanine debt, unitranche, or even distressed debt. Initially, they emerged to fill the gap left by banks after the financial crisis in 2008, when the banks pulled back from riskier financing activity, but since then it's exploded and now the industry is huge. These funds compete directly with banks. The essence is that you underwrite debt, structure terms, and get paid back with interest. And this interest is typically higher than what banks charge, but we won't go into that for now. But if you're interested, drop a comment below. Titles vary. You may see private credit analyst, investment associate, direct lending analyst, but ultimately you sit on the buy side, analyze companies, and execute transactions. In terms of the day-to-day, you will source and evaluate lending opportunities, and this is typically alongside private equity firms that are looking to buy companies. You'll build financial models to assess cash flow and repayment capacity, and you'll structure loans, so that's the size, interest, terms and protections, security and collateral, and so on. You'll then compile all of this into an investment memo, and you will pitch this internally to investment committee to get approval for the deal. Once deals are done, you will also monitor the portfolio companies, make sure they're performing well on servicing debt, and look for additional lending opportunities here. And because a lot of these deals are tied to M&A, you'll work closely with investment banks and lawyers during execution. In terms of hours, you're looking at 50 to 70 hours per week, so it's a bit less intense than investment banking and private equity, but it's still deal driven and still intense, and if you're on a live deal, you can expect late nights. Pay-wise, this is where we get serious. Analysts and associates can expect anywhere between $100,000 and $150,000 base, plus 30 to 100% bonus, maybe more, and that can take total comp to $130,000 to $300,000 analyst and associate level. VPs and directors will be on $200,000 to $300,000 base, and with bonus, this can easily rise to $300,000 to $500,000. And then MDs and partners will be on $750,000 plus bonus, equity, and carry in the fund itself. And the key point here is the pay is Wall Street level, but the hours are a little bit more manageable. But in terms of breaking in, the difficulty is high. It's a buy-side role, and funds will typically look for investment banking, leverage finance, or credit research training. So to get in and enjoy the income that comes with it, it's definitely a grind. You have to put a lot of hours and years in up front, but once you're in, it's probably worth it. Now, in terms of entry routes, the classic route is via investment banks, so leverage finance, capital markets, or the sponsors team. It is also possible to break in via Big Four valuations or transaction services teams, so think PwC or EY. It's less common, but if you've worked on debt-heavy deals, it is possible. And finally, less common, but credit ratings agencies or sell-side research is also a possible side door. Generally, they're looking for strong credit and financial modeling skills and ability to structure terms and otherwise manage downside risk. So to summarize, private credit is where you lend like a bank but earn like Wall Street. It's deal-driven, growing fast, and pays six figures early in your career. So if private equity feels too competitive, then private credit can be a good play. You're still in the deal flow, but looking at things from a credit lens rather than equity. Now let's look at the role that everyone's heard of that comes with the biggest hype and yes, the biggest paychecks. If private credit is about lending, private equity is about owning. You buy the company, you fix it, and you sell it for a profit. It is a pinnacle of buy-side prestige, and yes, the comp will be life-changing. In terms of how they work, private equity funds raise capital from multiple sources, so institutional investors, sovereign wealth funds, pensions, and high net worth individuals, and then they will invest this capital in buying stakes in private companies. And the classic model is to buy a company, make it more efficient or grow it, and then sell it at a higher valuation. And the strategies can vary, so leverage buyouts involve majority stakes in large companies, so it's basically full ownership. Then you have growth equity, which tends to be smaller stakes in smaller companies, and then you also have distressed investing, whereby you're trying to improve or fix a struggling company. Title-wise, it really depends on the seniority, so you do get analyst roles, but they're rare. It's typically associate and above, and then you'll have VP, director, and partner. and you firmly sit on the buy side. Your job is to source, analyze, execute, and manage deals. And in terms of the day-to-day, it's pretty cool stuff, and it goes much deeper than private credit. So you'll be evaluating potential investment opportunities. So you'll do a full deep dive on the company, its drivers, you'll model its financials, you'll do market sizing and competitor analysis. You'll do deep due diligence, so you'll work with consultants, lawyers, and bankers to vet every single detail. You'll negotiate purchasing terms with the seller and also structure a deal, and this will typically involve a fair amount of debt, which is called leverage. And once you've done the deal, you will work with portfolio companies and management teams to help execute the plan. So that could be a growth plan or cost cutting, etc. Typically, PE firms will hold a company for 3 to 7 years, so that's called the investment horizon. And along the way, they will start thinking about the exit plan. That could be an IPO, i.e. listing the company. It could be a secondary sale to another private equity firm, or it could be a trade sale to a trade buyer. Generally, everything is deal driven, so your workload will spike hard when you're on live transactions. In terms of hours, you're looking at 60 to 80 per week, but it can definitely go above this if you're on live transactions. So it's probably not as grueling as an analyst role at an investment bank, but it still consumes your life, but the pay can more than mitigate this. Now, in terms of pay, at associate level, you're looking at $150,000 to $200,000 base, and bonus can take this past $200,000 to $300,000. At VP or director level, or principals as they're known, you're looking at $250,000 to $400,000 base, and with bonus, this can easily pass $500,000. And partners are looking at $1 million plus, with the real wealth coming from carry, which is a share of the fund's profits. The bottom line is it's one of the highest paying careers in finance, but it's also very difficult to break into, because the reality is private equity is the most competitive buy-side role. Now, the classic path is investment banking analyst to private equity associate. So if you're thinking about IB, you could target PE after that, and that's where you'll make real money. In terms of other entry routes, it is possible to transition from consulting, especially if you've worked at a top tier shop. And here you may be able to target more operationally focused private equity funds. Otherwise, if you work in corporate development or strategy at a company, it may be possible to transition into a mid-market fund. Exceptional candidates from Big Four transactional services or valuation teams, such as at PwC or EY, etc., can sometimes sneak in alongside those from law. What they're really looking for is world-class modeling skills, ability to think strategically about businesses, and the stamina to survive deal work. So to summarize, private equity is the best buy-side seat. You're not just analyzing or lending, you're owning. The stakes are high, the pay is huge, and the doors that it opens are unmatched. But it's also one of the hardest seats to land. The lifestyle is demanding, and the investment horizon, as I said, is long, typically 3 to 7 years. So you have to be patient, because the projects you work on can take a year plus. So if you want to know whether you have what it takes, pick a recent private equity deal, read the press release, analyze the company, and then put together a 1-page investment memo. Consider why you should buy it, whether the valuation was fair, how it should be financed, and what the upside potential is and the downside risks are. Finally, let's look at why it's probably the sexiest role in finance, where instead of buying whole companies, you are making bets in public markets and chasing alpha every single day. Now imagine getting paid for betting on your ideas, where one well-researched investment thesis can make or break the entire year. That's the life of a hedge fund analyst. Unlike private equity, where you hold companies for years, hedge funds play in the public markets, where ideas can play out in weeks, days, or even hours. If private equity is about owning companies, hedge funds is about outsmarting the market in real time. It's high stakes, high intensity, but for the right person, incredibly rewarding. Think of yourself as a detective of businesses. You pick a company, you dissect its financials, you speak to management, you look at its competitors, and then you put together an investment thesis saying, this is why the market is wrong, and this is the bet we should place. Titles are typically investment analyst or research associate, and you spend the day writing investment memos and pitching ideas to the portfolio managers who can put millions behind your idea. Now, the strategy depends on the fund. So some do long-short equities, some trade macro and rates, others run quant models. But the core is the same. You identify mispricings, you place bets, and you manage risk. So in terms of the day-to-day, a lot of your time will be spent on idea generation. So you'll be doing deep research into companies, industries, and themes. Then you'll build financial models and write investment memos and pitch this to the portfolio manager, who decides whether this makes it into the portfolio. Once you place your bets, you monitor these positions real time and update them as new information comes in. And around earnings season, it will be super busy, because remember, you're in public markets, so this new data is typically earnings announcements. So once they're published, you will spend late nights dissecting this information. Hours wise, you're looking at 55 to 70 hours per week, so it's not as intense as investment banking, but the pressure is arguably higher because of the amount of money in play. In terms of pay, it's high, but it's very much performance driven. Analysts can earn between $100,000 and $150,000 base, but between 50 to 150% bonus depending on fund performance. As you become more experienced, this can rise to between $200,000 and $400,000 in total compensation, and then when you rise to a senior analyst or portfolio manager, you're looking between $500,000 and $1 million. And if you're a star portfolio manager, it can be much higher than this. The key point here is there is huge upside, but there's a lot of variance in pay. In terms of breaking in, it is very hard. There are not that many hedge fund seats, and funds are very picky and they want people who live and breathe markets. The most common path is via investment banking. However, hedge funds do hire people with technical backgrounds. So if you have a quantitative or engineering background, you could target a quant fund. What matters most is your ability to generate stock ideas, and a lot of interviews will hinge on your ability to pitch a stock and defend your investment thesis. And the truth is, you can't fake curiosity. You genuinely need to be someone who enjoys reading about markets on a Saturday morning. And this is where positioning this effectively on your CV and in interviews is also very important if you want to stand out versus your standard rich kids from Wharton. So to summarize, hedge funds are essentially where intellectual curiosity meets money. Your entire career is built on ideas, and for some people this is super exciting and thrilling, and for other people it's very scary. You're betting your career on your brain, and your school board is very public, so that's a lot of pressure. So if you want to know if this type of work is for you, pick a public company that you know well and put together a 2-page investment thesis. Detail what the market believes and where you disagree, and back this up with a few bullet points that are well researched. If you enjoy this, then this may be for you. So with all of that said, now let's zoom out and compare these 7 roles side by side to see which is the best choice for you. If you love analyzing business levers and want executive exposure, FP&A could be a good fit. If you want to control the heartbeat of a company and balance cash and hedge risk, corporate treasury. If you're client driven and enjoy building trust and relationships and want finance with a people angle, consider commercial/corporate banking. If you've got a systems mindset and like preventing problems before they blow up, consider risk management. If you want deal exposure, enjoy modeling and structuring deals, and prefer credit over 100-hour work weeks, consider private credit. If you want the best buy side seat, you want to own companies and chase big exits and big money, consider private equity. And if you're obsessed with markets, love independent research, and want to outsmart the world in real time, hedge funds is your bet. Now, each of these roles can take you into 6-figure territory, but it's really about which one best fits your skills, personality, and tolerance for risk. And that's why for every new client at Charter Mastery, we first take the time to analyze their unique situation, their skills, their goals, their preferences, lifestyle priorities, and the state of the markets. Only then do we select the role that's the best fit for them, and then we pursue that. So it's not just about targeting PE and hedge funds just because they pay the most money. It's about picking a role you connect with, developing a strategy, and then moving you towards that goal. Now, maybe you're thinking, I don't come from a target school. Well, neither did I. Or otherwise, maybe you're thinking, I don't have a finance degree, or where do I even start? Look, if you believe in yourself and you really want a successful career in finance, there's nothing stopping you. You just need to take action. Now, if you want to learn more about careers in finance, then go ahead and subscribe to the channel and watch the next video. See you next time.